Gang, okay, welcome to the YouTube video. All right. Well, today they came out with the numbers. They keep telling us we have this great economy. Oh, really? They're going to raise rates, but they don't. And for a very good reason, because the economy is not growing. In fact, today they came out and said our second quarter GDP was revised downward. That's right. They revised it down from the 1.2 to 1.1. So that's not working for them. So not only that, but that's the backdrop. Yesterday we learned that our capital goods, now capital goods, okay, are big items, okay. These are the goods that our companies build machinery to send to factories to build the goods for us folks. That's part of the durable goods. So example, they will build equipment to send to Caterpillar so they can build a bulldozer. They'll build equipment that builds the locomotive engines that the GE builds. Very, very important. And when that is just tanked, that tells you as durable goods, when those start tanking, that's the most reliable. Your durable goods and your capital goods, which is all same group, that tells you exactly how well the economy is doing. So they can lie all they want, say how we're great, we're doing well. Well, that shows you we're not doing well. On top of that, of course, you know, we've had 6 consecutive quarters of negative earnings. Industrial production is down, manufacturing down. Manufacturing orders are at the weakest in 10 years. And we even have the housing market. Housing is numbers are dropping. They say, well, there's not enough inventory. No, it's not the inventory for housing. That's not the problem. The problem is people don't have enough good jobs. So if they don't have it, if I'm a builder, okay, am I going to go out and start building? Am I going to go out and start building houses? Of course not. The problem is if people are making, let's say, $12 an hour instead of what they were making, $32 an hour, okay, they don't have, and they're renting, and their rents have gone through the roof, okay, they're paying half of their income for rents. They're not putting enough money aside for savings, and because there's no savings, people cannot get the down payment they need to buy the house. So instead of being honest with us and saying it's our crappy labor market where we're shipping all our good jobs overseas for $12, but we used to get $32. Now we're getting $12 jobs back here compared to $32. We're not saving any money. We can't put up a down payment, and therefore and not only that, but 45% of all home sales is what contributes to our overall housing market. 45%. But guess what? That 45% has dropped to now no longer 45% of the market. It's a negative 33%. They're gone. They're gone. Okay. Not only do they have terrible jobs, that 45% of the people who contribute to the housing market are gone. First-time home buyers are gone. Now, but they keep telling us we got a great economy, right? Well, that's not true. Now, if you go back and you look at the stock market, okay, the market in 2008, as you know, plunged, okay? All right, and then they stopped it, plunging right here at this point, and then the stock market started to go back up. And they kept moving the market up to where we are today, up here, where we stalled. And we've been going sideways for almost more than a year, right here, and we stalled. That's where we are. But here's what's interesting. Everything's just fake. Everything's phony, okay? Because you got to think of it this way here. When the stock market collapsed, how they got the stock market to stop going down right here is very simple. It's a little trick they used. Okay, all they did to stop the market, they just propped it up. How do they prop it up? Over here is what we call is the bond market. Okay, there's the bond market. Now the bond market, what they did, the Federal Reserve goes in and they print money to buy all the 10-year treasuries, okay? So they buy all these 10-year treasuries with all the printed money. So here's all the money they keep printing. There's the money they print. And they go buy the 10-year treasury. Now, why do they buy the 10-year treasury? Because who buys most of our treasuries? That's our debt. Big countries, Saudis, Chinese, a lot of other countries, but just take the Saudis and the Chinese. They buy most of our debt. They give us, we need cash to operate because we spend on average $1 trillion more a year than we take in. So we always are running a deficit between 850 billion a year to a trillion a year. That's our deficit that we run. So we are spending 850 to a trillion more than we take in. So what we do is we have to go get that money because we need that money to pay our bills. So what do? We sell it to the Chinese and the Saudis mostly. So they buy, we give them a 10-year treasury and they give us the cash. So we print money, okay? We give them the cash, they give us the cash and we give them a treasury bill saying we're going to owe you in 10 years at an interest rate of 5%. Okay, we're going to pay you 5% for 850 to $1 trillion. You give us this money right here, this cash to take care of this, and we'll give you 5% interest. Well, they're happy. That's the yield. It's called yield. That's the yield they're getting on the 10-year treasury. And that's all fine and dandy, okay? But what's happened is when the market started to crash right here, they had to stop the market from crashing. So what do? Well, they take the 10-year treasury right here, and they got to stop these countries from buying our debt. They want them out of here, okay? They don't want them buying our debt. So what they do is so now the Fed comes in, they take their machine, here's the machine, it's the Fed machine, print, and they print money, and they buy all the 10-year treasuries. By buying the 10-year treasuries, all of a sudden it goes from 5% down to 1.5%. Well, they're pretty grumpy, the Chinese and the Saudis, because they're getting 5% to buy our debt right here. They were getting 5%. Now they said, look, give us 850 billion to 1 trillion. We'll give you 1.5%. They said, we're not going to do that. Not when your S&P over here is giving me dividends of 2.5%. And that's what they do. They take and they purposely, the Fed prints money to buy the 10-year treasury to drop the yield so it's unattractive. So they take all the Saudis and they come over here and they prop up the stock market. They take the Chinese, they come over here and they prop up the stock market. They take the Germans, the Canadians, everybody who buys, but it's mostly Saudis and Chinese, hold our market up. So that's how they hold it up, by buying all the 10-year treasuries, printing the money. Fed prints the money. They buy the 10-year treasury and it drops it down. And these guys do not want 1.5%. They rather have 2.5% dividends they get in the stock market. That's what stopped it. Now, the problem is that we didn't fix what was wrong. What was wrong was what caused this crash. What caused this crash is this, is that just the same thing in 1929. In 1929, we had the biggest crash because why? Because they had under one roof, okay, the banks, they had little banks. You could have a commercial bank, okay? You could have, you could sell commercial loans. You could, a bank could sell insurance policies. A bank could give, sell mortgages, insurance. They could even do mergers and acquisitions. So all under one roof. Now that's a problem in 1929, because in 1929 that means that they have all this cash under one roof. The problem is in 1929 they take all the cash and they go speculate. And when they speculated, they took wild speculation, and then the market crashed because of the speculation. They decided, let's do this. They came up with a bill called the Glass-Steagall bill. They said, let's break these banks up. Let's make them separate. So the banks had to make a decision. So let's just do this. No more were they under one roof. You had to make a decision. You're going to sell mortgages, you're a mortgage bank. You're going to do commercial business, you're a commercial bank. If you're a savings bank, they're all separate. That way, never again will they have all this capital to go out and drive the market any way they want and speculate and put us in that position again. So they're all separated, is what they did. They separated them out. But when Clinton showed up and his gangsters, and you had Greenspan, you had Summers, you had what the hell is his name, head of the Treasury, Geithner, they decided they wanted to bring it back to one bank again because they wanted all the cash under one roof so they could go out and speculate again, okay? And that's what they did. So they killed the Glass-Steagall back, and now everything is under one roof. So everything was under one roof, and that was the fault of our friend Bill Clinton. Put them all back under one roof so they have all this cash again to go speculate. They did, and that's when the stock market crashed, okay? Again, it was the housing at this time. That's what crashed. So what did they do to stop it from crashing? Well, they should have went up and split these banks all up. There's 8,500 banks in the United States. The 8,500 banks and insurance companies could have taken all pieces of these big banks, the 9 biggest banks, there's 9 of them. Okay, they could have taken and broke all these banks up, and the 8,500 banks could have taken all their parts. And that would have solved the problem and fixed it, and they should have put Glass-Steagall back in again. Well, these 9 banks are so powerful, and they own Congress, and they had such lobbyists, they wouldn't allow that to happen, and Bush was bought and said, no, don't do that to us, okay? So they decided, let's not do it. Obama came in right after that, the same year. Remember, he got elected. He did the same thing. He was owned by the bankers. Hillary is now owned by the bankers, okay? And so until we fix the problem of going back to the Glass-Steagall Act and break them all up into single banks again, we have that same problem, too much cash under one roof for them to go speculate, and that's exactly what they did in the rally we have here. So what they did, they stopped it, they didn't fix it. Nobody understands that. So what they decided to do is what they did called QE. The first thing they did before QE, as I told you, they stopped it by printing, the Fed printing money, okay, and buying all the bonds to drop the yields down to 1.5% to move the Saudis and Chinese over here to hold and stabilize the market. Now they had to grow the market. Well, there's no earnings, no profits, okay, so what did they do? They decided to do QE. What's QE? Front-loading the stock market, take the printing machine and print $3.2 trillion and take that money and give it to the banks to buy stocks because there's no earnings, no profits. People didn't have money. They weren't consuming. So that's what they did. So the first one they did was QE1. Okay, and they did remember they did QE1, and they injected, on QE1, they injected $1 trillion, and they got an 80% stock market rally on QE1 with $1 trillion investment. Then it started to pull back. They decided to go do QE2. So now they did QE2, and they put QE2 in. They put in another $650 billion on QE2 right here, 650. And they went and bought stocks again to keep pushing the market up. Then they did the twist up here, which same thing, the twist they put in. But this time here, remember, they had an 80% return here. On the 650, it dropped from 80% to 33%. So now it's going downwards, even though the market's going up. They decided to do the twist, and on the twist, they did another $400 billion. So now they got $400 billion on the twist. Now, and the market went up on the twist 28%. So you can see what's happening. The market's slowing up. And then finally, at the end, they finished it off, and they stopped in October of 2012, right here. And that's when they did the final $1 trillion, again, $1 trillion right here, $1 trillion. And at $1 trillion, how much did the market go up? It only went up 25%. So what's happened, you can see from the first trillion they put in down here, where the market went up 80% off the first trillion right here. Now another trillion only went up 25%. That's a bigger problem, isn't it? So that stopped. So all of this money they told us was to go in, they're going to increase jobs. That was a lie. The 5 percentile, the smallest segment of a very small segment of the population, controls the stock market. All their income comes from the stock market, mostly dividends and so forth and capital gains. Okay, these are the big boys. 5%. They got filthy, filthy rich. Okay, terrific rich, very, very wealthy. Because look how it went up. But remember, this was never fixed back here. The cavity was still here. The cancer was still here. So now what happened is they figured, uh-oh, what are we going to do next? They got the printing machine out. Okay, printing more money, printing more money. They kept printing money, and they did what they called stock buyback. So they decided, let's give the companies money to buy their own shares. And they did. So now the companies were buying their own shares because there wasn't any profits. And then, of course, the stock, that brought us right up to where we are now. They put in $7 trillion to buy their own shares, $7.7 trillion to buy their own shares. That brings us up to where we are now. Remember, it was never fixed back here. But now, all of a sudden, there's no more QE. There's no more, the stock buybacks are almost done. They're trying to push out. And they've been trying to push out, and they finally got a little bump, and that was the end of it right there. Okay, they forced it up, but it didn't work. And now the problem is, how are they going to get it the rest of the way? There's no earnings growth. You can see our earnings growth is going down. So they got to get that market to move up. So they're going to have to do QE back here again to move the market up, or it's going to collapse because there's no way to get earnings because the consumers are getting weaker and weaker. They're not out buying stuff, and that's the problem. So where are we today? What's going on with this? They came out today and they said that the market, they're not going to raise the dollar. Now, normally what happens is this. When the dollar goes up, okay, when you take the dollar and you push the dollar up, okay, when the dollar goes up, when the dollar goes down, that's usually very good news, okay, because when the dollar goes down, what goes up, okay? The stock market usually goes up. The stock market goes up. What else goes up when the dollar goes down? Gold goes up, okay? So you also have gold going up. So you have gold going up, okay? So the stock market goes up with the dollar going down, okay? So you have so again, your stock market goes up like this, and you got gold going up like this, okay? And that's when the dollar is going down, okay? Now, normally what they're doing is they're telling us they want everybody to believe that the economy is getting better because they want to push this out. So they keep telling us they're going to raise interest rates. Well, when they raise interest rates, what does that mean? When you raise interest rates, that means the economy is doing better. And anytime they say they're going to raise interest rates, the market goes up. And also what goes up is the 10-year Treasury. Okay? So when the bond yields turn around, they start going back up. So anytime the economy is doing good, and that's why they keep saying the economy's doing good, we're going to raise rates. Every time they say to raise rates, it's for the purpose to make sure that they push the dollar up and they push the 10-year Treasury back up. Because what does that mean? Anytime the dollar goes up and the 10-year Treasury goes up, looking forward out in the economy, it means the economy is doing a lot better. So how do they artificially do that? By just saying they're going to raise rates. And it keeps working. Okay, it keeps working. But it hasn't worked. Nobody believes them anymore. And that's why we're stuck right here. So today they came out and said, well, they said that they're not going to raise rates. Okay, not for now. They may raise rates later on. Well, that's not much of a help. We need them to tell us they're going to raise rates so that the dollar will go up. Instead, what happened today, the dollar did what? The dollar came down, all right? So, but why isn't the stock market going up? I just said the stock market goes up if the dollar goes down. Gold went up, but why isn't the stock market going up? Dollar came down today. Well, because the stock market is smart, okay? There's no earnings. It's a cancer. There's a cancer. Instead of going up, the stock market got a cancer in here, okay? It's not going up. So what they got to do, remember what's happened here, what has left, all this money has come pouring out of the stock market. What money? The 401k people pulled out of the stock market. You got the 401ks, they pulled out. The pension funds have pulled out. The hedge funds have all pulled out. They've all pulled out. We have not seen so much money coming out at such a fast pace since the 1950s. It's incredible which money is pulling out. Well, how are they holding the market up there? Why is the market dropping? Because they did the same thing they did back here. The same thing. They're printing money to buy the bonds to drop the yield. We dropped down to 1.4%. They're doing the same thing. They dropped it from 5.1 down to 1.5%. So now they're holding up the market over here. Okay, just like they did down here, right? Just like they did when the market crashed in 2008. So that's what's holding the market up right now, right there. doing the same thing as they did down here by printing money, and the Treasury buys all the bond yields. It drops the yields, and all these countries come out, don't buy our debt anymore. They're not buying this debt in here anymore. They decide to go for the 2.5% like they did down here. So now we're starting all over again. So the only thing is to move this market up is QE and buying in stock buybacks. That's the only thing that's going to move this market up because there's no earnings. So you heard what she said today. She said, well, she says if there's going to be she says we are ready to do another QE if we go into a recession. Well, she knows we're going into a recession, and that's why this is going to start all over again, and it's just a matter of time. And they need to do it to make sure that Hillary Clinton gets elected, okay? So that's what we're waiting for. So so anytime, remember, when the dollar goes down, stocks go up and gold goes up. But this time, when the dollar went down, the market's not going up because everybody's left the market. The big hedge funds, everybody, pension funds, they all left, and they're parking over here. The only way they can get them back into the market is by doing this. Then they come back in, you see? So that's all that's left to them is QE and stock buyback. Start this all over again. At some point, it's not going to work, and that's why it's a beautiful thing to be in the market, because if they do this, which they're going to, more stock buybacks, more QE, so the market continues to go up, and then it's going to crash. It's not sustainable. You can't keep doing that. Why? Because all this printing of money to buy stocks and buy bonds, the dollar value goes down. The dollar value starts decelerating. And what do we hear today from all the customers? That we saw that Dollar General and the other one, okay, they collapse. Their stocks collapse because the people who go to those stores are the people who make between $28,000 and $32,000 a year. And the problem is they don't have the buying power anymore, because what used to buy, they could buy for $1. They no more can buy for $1. They need $1.50. They need $2 to buy the same stuff. So this is what happens. And that's called deflation. And eventually it's deflation that makes the market collapse. Okay. And so the more they print to artificially push the market up through bond buying to stabilize it, through QE to push stock prices up, all that printing of money, then the dollar keeps getting worse and worse. And that's why we saw such terrible earnings with Dollar General, and there's another one, Dollar Tree. They collapsed. Wow. So it can't go on forever. And that's why being a gang member is perfect. Being in the stock market is perfect this time, because if they do QE and stock buybacks, we'll catch it on the way up. And know what we're going to catch? We're going to catch one of the biggest crashes we've ever seen on the way back down, right down to where this started, right here. Because this is all a bubble. And anything they do beyond here is more adding to the bubble. So the dollar printing has got to stop. So always remember, the dollar goes down, the stock market's supposed to go up, and gold's supposed to go up. And that's why that's why we've over 100%, we've made over 100% gains in gold. We started in December of 2015 because I knew this was going to happen. And so now, again, when that dollar goes down, you don't see the stock market going up. It's the only way they're going to get it up. And then you know it's going to be a crash, because the more you print money, the more deflation comes in. Okay? Hope that explains what's going on. They got to get back to here. They got to get back to putting all these banks under one roof again. Because when you break them out, they always do the same mess here, the same thing. They got to take, every time they take the banks and they don't break them out, you got to make them individual banks. You can't have them under one roof. Under one roof, there's too much cash, and they speculate, and the market keeps going up, and it doesn't have earnings. You got to take these and break them back out, just like they did in 1929. After the 1929 crash, they broke them out into all single banks. Okay, you got to have all single banks. That's what you need. All individual banks, not under one roof. And they got to come back in with the Glass-Steagall Act. If they don't do that, then we're really screwed. Okay, so that's where it stands. I hope that explains to you why we got a big crash coming, and I will see you on the charts.